Good afternoon, folks. It's Dave Burrows. I am Chief Investment Strategist and President of Barometer Capital Management. And I want to thank everybody for joining us today for our weekly webcast. Every Tuesday at 4 o'clock, rain or shine. We look forward to doing this and catching up with clients and friends of the firm as to what we're seeing going on. As we're coming into year end, there is some position squaring up going on. Portfolio managers are looking at their winners and their losers and taking the opportunity to take some of the losing positions off to perhaps catch some tax benefit for tax loss selling. We've got a Fed meeting tomorrow, which people are looking at very closely for indication as to the future rate path of interest rates and the rate of tapering of the Fed's bond purchases. And we've had some economic data over the last week. And so lots to talk about. And so why don't we just jump right in? Just to kick off from a 30,000 foot view, we believe we are in a structural bull market in stocks that started in 2013. And they tend to go on a lot longer than you think. They do certainly have corrections along the way, but it's sort of 4 steps forward and 1 step back. And as you make new highs, people are always concerned that the market's making its final new high. And as you can see, once you're in a structural bull market, they can really go on for a long time. We've been going through a structural bottoming in interest rates, going back really to 2016, 17, much like the bottoming in rates that took place in the late 1940s and early 1950s. And what we know from previous shifts in long-term secular bull markets and bear markets in rates, they don't happen on a dime. They happen over a period of time. It's more glacial in process than in the stock market, but it has important implications because what works in rising rates generally is very different than what works during falling rates. We also think that we went through a bottoming process over the last couple of years in commodity prices. We know we got to a point where the 10-year compounded return on commodity prices was almost minus 10% a year for the previous 10 years. We've now moved a little higher and we're back through the zero line. But we know once you cross through the zero line in a new bull market in commodities, again, it can go on for 10 years. And by the end, you might have 10-year compound returns of 15 or 20%. So there's a long way perhaps to go there. So it's important to watch, especially from a Canadian standpoint, because a lot of our market does have exposure to commodity markets and thereby exposure to global markets. We talked a little bit about the fact that we are now into a seasonally stronger period, which leads from now until March, April. There is some general bumpiness through November and can be early part of December, which we've certainly seen some of this year. But generally, by the middle of December, you're into sort of a year-end rally. People have completed their squaring up process in their portfolios and repositioning and are getting ready for what may be coming next. And so here we are. We're into the middle of December. December can be a very, very good month. Now, we talked over the last few weeks about the fact that even though the indices really haven't pulled back far off the highs, the average stock has. And I put this up last week. The average stock in the S&P had declined about 13% off the highs. So some notable exceptions to that, companies like Apple and Google, which had held in particularly well. But lots of companies under the surface were in some correction. If you were to take the Nasdaq Composite today, it's interesting, 73% of the companies in the Nasdaq Composite are down 20% or more from the highs. And that's been an interesting process, watching the market sort profitable technology from unprofitable sort of concept technology. Some of the things that we were talking about last January and February during the meme stock boom, people couldn't explain why companies like AMC, which was close to a bankrupt company, shares were going through the roof, and certainly new private investors, retail investors were getting involved in the game while they were locked in their homes and certainly pushed some of those companies higher, but they don't go higher forever. As we sit today, the S&P is sitting not far off the highs. We talked last week about the fact that we had seen a nice sharp reversal off the 50-day moving average after correcting about 6%. And we had 2 back-to-back days where 80% of the companies in the S&P were up on the same day. Now, that doesn't happen very often. It means that it's been tremendously strong breadth for a couple of days. It tends to mean that there is a new thrust in the market. And if you look at the statistics moving forward, 1 month, 3 months, 6 months, 9 months, and 12 months, generally it means you've seen sort of a short-term bottoming process, which is funny because really the S&P wasn't that far off the highs, but as we just talked about, the average stock has gone through a correction over the last few months and been masked very well by some of the largest cap technology stocks. When we look at the Nasdaq did pull back. Nasdaq 100 did pull back a little bit more than the S&P, about 7.5%. But as I said, 73% of stocks in the Nasdaq Composite were down 20% or more. We also had two very good breadth days in the Nasdaq, and then we tested a little bit. And today we went back and there was a little gap left on the chart. Often when the market closes at one level and has a big gap up in the morning, at some point over the next week or two, you'll come back and test that gap, which we did today just above the 50-day moving average. So you'll see that theme actually in a lot of sectors, and not that that's a good thing or a bad thing. It just tends to happen. It can always get worse from here and it can always get better from here, but that wasn't an unusual thing to see. When we look at the Nasdaq Composite, so broadening beyond the top 100 companies in the Nasdaq to all of the companies in the Nasdaq, you can see the same picture. We gapped higher, and over the last 4 days have pulled back, tested that gap. And obviously there are some people who are concerned to say, well, we made a lower high, maybe we're going to make a lower low, maybe the Fed's messaging tomorrow will be concerning to the market. So we'll have to assess that as we go through this conversation today. So here is graphically what we've just been talking about. This is the NASDAQ itself versus the percent of stocks in the NASDAQ trading above their 200-day moving average or their long-term support. So over the last several months, we've been talking about the fact that in our portfolios, we have been carrying a lower exposure to technology and a lower exposure to the NASDAQ itself. As we sit today, we have a little bit less than half of the index's exposure in the S&P to technology. Not to say there aren't a lot of great companies, but you always have to ask the question, if something isn't behaving the way that it should be, given what you think you know, maybe there are other issues. And certainly we've talked about the fact that valuations in technology companies have been quite high. And if you believe that rates could go higher, paying a very high multiple for earnings into the future and then discounting them back with a higher interest rate means they're worth less. So this has been something that has been a theme now really since the spring. Some of the biggest cap technology stocks, ran out of steam through that period. And we've certainly seen a very significant correction. Many of the stocks that we talked about in February of last year scratched our heads at unprofitable companies going through the roof are down 50 to 75% since then. And now, given the fact that we're in the middle of December, certainly are candidates to be sold to offset gains in other parts of the portfolio. So this has been a group that we have largely avoided. A great proxy for that group would be the ARC ETF. This is Cathie Wood's Future Innovations ETF, which is filled with companies trading at very, very high multiples like Teladocs and Roku and Coinbase and Zoom Video and Spotify and Twilio and so on. You can see this really has not been a good place to be since last February, and today coming basically back to last week's lows. So behaving significantly worse than the market. This is a message we have to take away. Promise of the future and unprofitable tech, probably not the place to be. If we take the NASDAQ and take out the biggest 5 stocks, this is NASDAQ Composite year to date, a pretty weak picture. Now, for the S&P itself, S&P has been working its way higher since we broke out in 2013. And probably has, in longevity, had roughly half as long a bull market as we saw in the 80s and 90s. It's actually just a fraction of the return, about 200% versus 1,100% for the 80s and 90s. So not to say that it has to continue to go higher, But there certainly is precedent, and that is what tends to happen in a structural bull market. So we have to remain open to all of the potential options. 2 weeks ago, through our lenses, we said, yes, there is some internal weakness in the market. The percent of stocks in uptrends in the NYSE had been falling, meaning fewer and fewer companies were carrying the day. Globally, it was the same picture. The percent of stocks trading above their 50-day moving average had been falling. The percentage of stocks trading with positive weekly momentum had been falling. Percent of stocks making new highs versus new lows had been falling. And the percent of stocks trading above the 150-day moving average had been falling. So we did voice some caution, but then last week showed some reversals. And as we sit today, our long-term breadth indicator, once again, is positive. And it turned up early last week. Same thing for Canada. Percent of stocks with positive weekly momentum got to a very low level and is now reaccelerating. Percent of stocks making new highs versus the ones making new lows is expanding. And the percent of stocks trading above the 150-day or long-term moving average has moved nicely higher over the last 2 weeks and sitting just right around 50%. So if we are concerned about the market bouncing around, we want to look internally to say what is driving it. Is the average stock getting beaten up? And we know that actually over the last 2 weeks, the average stock has been getting a little better. And certainly there have been better days and worse days. But to us, it means that there are shock absorbers in the market. For all of the negative pieces of news that we see, there are enough positives where the net internals of the market have in general improved over the last 2 weeks, not become weaker. So here is the equally weighted S&P 500, which takes each company and treats them all the same, whether you're Apple or Textron. And you can see, yes, it's certainly corrected, but it had quite a nice bounce last week, bigger than the S&P itself, and backed off a little bit over the last few days. But today, for instance, when the S&P was down 1%, the equally weighted S&P was down 50 basis points, roughly half. So this tells me that the average stock is acting better. And while everybody likes to stare at the index itself, which is so heavily dominated by the biggest companies, we'd prefer to know what's happening to the average company, because realistically, that's what's going to have a bigger impact on our portfolios. So let's look at some other indicators. Let's look at volatility. Last week, we referenced the fact that volatility had spiked the week before, and that when it made its lower low, actually the close on volatility that day was at a lower level. Well, now we pulled back over the last few days, but volatility really has not picked up. Again, that tells us internally in the market, while yes, prices are moving around, the traders are not expecting a big pickup in volatility coming out of tomorrow's meeting. So volatility telling us that things are a little bit more muted. Let's look at some of the data from this week. Obviously, there have been things that people are concerned about. Omicron is certainly a concern. We probably have more information today than we did 2 weeks ago, right after Thanksgiving, when the market got quite badly slammed when news of the variant came out. We certainly continue to see inflation data in the market. The market's getting their head around what that might mean. Is it transient? Is it not? It may be that the supply chain issues are getting better, but certainly wage inflation is there. And we also have uncertainty this week about Fed policy, and we'll get more information tomorrow. But as we move forward, the market is telling us that it believes we are getting more information, not less. The market hates uncertainty. As we have learned that yes, Omicron spreads very rapidly, so far we haven't seen much by way of hospitalizations. So these are active cases from new test positives. These are hospitalization rates. So far, no uptick in hospitalization rates. That's very encouraging. If this is something that we can learn to live with and learn to treat, it has less impact longer term on the market and the economy. Let's talk about CPI. Last week, certainly the data came in hot. These are month over month inflation rates, and then the cumulative 12-month impact, which came in at 6.8%. certainly something to watch. One thing I think is interesting is that the month over month came down. And one of the things that will have an impact on this is supply chain bottlenecks. My guess is, as we talked about before, supply chain bottlenecks will probably be cleared more quickly than we expect. We'll have to see what the outcome is. And let's look at how the market is reacting to this stuff. But certainly CPI is something we have to keep an eye on. When we look at the economy itself, unemployment claims continue to come down. In fact, we're getting very close to where unemployment claims were coming into the pandemic. We had a giant spike and slowly they've come down. The Fed's goal was to get back to more normal employment, which certainly looks like we are getting there. So it may be that while we'll get tapering, and it may be that we'll get rising rates over the course of the next year, which we have expected, that the market and the economy can handle it. Because certainly the economic data has been strong. And from an earnings perspective, earnings have been getting better. When we look at the near-term earnings per share expectations going forward, they have been steadily rising since early spring 2020. There's been no rollover of expectations for next year. Expectations have continued to work their way higher. And in fact, profit margins also have been expected to work their way higher. So people talk about how expensive the market is, but the fact is earnings are growing faster than the S&P is going up. And since July of 2020, the near-term price earnings multiple has actually been slowly coming down. So I'm not so concerned about that, but there is a wide differential between the profitable companies and unprofitable companies. We'll talk about that as we go along. So let's talk about leadership. As you know, our job isn't to be everywhere. We get hired as active managers to identify big structural themes and focus in those areas that have a tailwind for as long as they have a tailwind, and to avoid, at some points, big parts of the market that may be very popular, but maybe where the tide is going out. We don't believe we have to be in every sector all the time. Our job is to differentiate market leadership from the laggards. So market leadership over the course of this year has been in sectors and themes that are positively impacted by an improving economy. Things that have been hurt over the course of the year have been things that do well during a weaker economy or during falling interest rates, what we call bond proxies. And also since February, companies that trade at very high multiples with very little earnings, where basically the earnings are a promise of the future. Now, we watch every day for signs of change, new leadership emerging and old leadership receding, so that we can say every day, does our portfolio make sense given what we think we know, which is one of the reasons we do this weekly webcast. We want people to understand what our thought process is, why it is that we are in the neighborhoods that we're focused investing in, and why it is that we're avoiding other areas. When there is no leadership or there is significant deterioration in our breadth models, which we just went through, which are improving, so that's not the case. If they were deteriorating, we have no problem playing defense. Right? I think that our clients know our job is to get to the sidelines if we get into a really sloppy market. That's not to say good markets don't have pullbacks, but when markets really roll over, we have to be prepared to play defense because it is a pretty tactical approach. So let's look at our leadership themes. As most people know, the biggest exposure we have in the portfolios, the ones that we think give us best risk reward, would be various areas of financial services. This is the XLF ETF. Made a high toward the end of October. It's consolidated a little bit since then. No real sign of volatility. This was the weakness early last week. We rallied, we pulled back and filled this gap in here, but frankly, is performing just fine. Trading above a rising 200-day and 150-day moving average. Within those groups, there's banks, there's insurance companies. We have lots of exposure in the US, but we have lots of exposure in Canada. This is the equally weighted bank index. So an equal weight of all the major banks. And you can see relative to the S&P over the last 2 months, it is significantly outperforming. This is relative strength versus the market. So financials continue to behave really effectively. And the fact is, if we think there's inflation or we're in a reflationary environment or that rates could go up, these are all good things for banks and largely the capital markets, banks, insurance companies, asset managers, and so on. Check. This is the XLK, which is an ETF made up of the largest of the big cap technology stocks, heavily dominated by Apple, Microsoft, Google, and so on. This was last week. We rallied toward the end of last week, and yeah, we pulled back a little bit today. We filled this gap, continues to behave really effectively above a 50-day, 150-day, and 200-day moving average. I would say, even though large cap tech pulled back a little bit, still continues to be very constructive. This is what we've seen over the year 2021. There's Apple within a whisper of being a $3 trillion company. Semiconductors have been leadership through the course of the year. They consolidated into the summer in July and then rallied nicely. We've consolidated over the last few weeks. Uptrend is completely in place and continues to be quite favorable. So let's move on now to energy. Energy, a more important area for the Canadian market. This is the XEG ETF, made up of Canadian oil and gas companies. We know through our research that Canadian oil and gas companies trade at lower cash flow multiples than US counterparts. We also, in many of them, have very long reserve lives. It's companies like Suncor and Canadian Natural Resources with decades and decades of reserve life and very strong cash flow generation. Also, some of the natural gas companies the same. But again, consolidating, trading in and around the 50-day moving average looks just fine. There's the point and figure chart for the Canadian energy sector. So these now, we've gone through financials, we've gone through technology, we've gone through energy. Major groups for us all continue to act quite well. Let's move on to industrial products. This is FXR, which is made up of industrial durable products. Yes, it's consolidated a little bit, trading better than 75% of the companies in the S&P 500 so far year to date. And again, corrected into last week, rallied, pulled back a little off that. Again, just consolidating, continues to act just fine. Let's talk about basic materials. Oh, just on profit margins. Profit margins now above where they were in 2020 before we went into the pandemic for the industrials. Let's talk materials. Materials is a major theme that I think that we'll have several years in front of us on. This includes things like agriculture, things like metals producers, things like forest products. Certainly consolidated and corrected into October, November this year, broke out, pulled back to the moving averages, and then turned higher. In fact, this week in a sloppy market has moved straight sideways, no real impact there. You always want to look at how things behave going through a bumpy market. Do they hang in or do they sell off? These groups are all hanging in. So groups like copper, which broke out of a range that's been in since 2015, have consolidated. Looks like it's ready to go again. I'm going to guess this is going to be a pretty strong group for 2022. Freeport-McMoRan would be one of the leaders in that group. Again, basically traded sideways this week against a bit of a sloppy market. Consumer discretionary, this is an equally weighted ETF, RCD, of consumer discretionary companies. Again, trading nicely above the lows from last week, pulled back a little over the last few days, again, trading above long-term moving averages, continue to behave well there. And these would include some retail, it would include some of the auto companies, it would include some of the consumer goods companies. In there, you'd have the home builders and the home improvement space, which is one that we continue to like. Again, trading very constructively. Now, part of that process I talked about earlier was saying, is leadership continue to be leadership? And beyond that, what is changing for the better? What's changing for the worse? And we highlighted over the last couple of weeks that there are a number of real estate investment trusts in the last few weeks that have started to perk up. One of them would be this ETF, REZ. We have individual REIT exposure in our portfolios in Canada, largely industrial REITs, but also some multifamily residential REITs. Pay a nice yield, and we're likely to get some distribution increases over the next year. This is a new area of strength we've been adding to in our portfolios. And then the other big change this week, and probably as a result of the Omicron variant, Consumer staples companies saw a very sharp increase and went on to make new highs after lagging for some time. So again, you're going to see we have a little bit more exposure there than we did a week ago. Now let's talk about income for a moment. In a world of rising interest rates, we need to have a rising stream of dividends or cash flows to offset them. Our theme for the year on income has been to own equities that have an ability to raise their dividend over time because they have pricing power. Now we know there's lots of companies that have been impacted by inflation, and the ones that have the strongest brands have an ability to pass along those increases to their customers. And in fact, in some cases, pad them and add additional pricing power, which means they likely can raise their dividends faster. Now, there's some obvious companies like some of those consumer staples companies that we just talked about. I know General Mills has raised prices on a number of their products by double digits. But there are other companies like some of the metals producers that, as they get higher prices for the metals like copper and iron ore, can raise their dividends along with inflation or more. So this is the RDVY ETF, and I put this up, I think, last week. It's been trading nicely above the 50-day moving average, above the 150-day moving, above the 200-day moving average. Very, very constructive. Now let's compare and contrast RDVY to high dividend paying stocks that have low economic sensitivity. These would be the things that do well in falling interest rates. And you can see that the global super dividend ETF, which is a high dividend paying ETF, has been significantly underperforming since June. So this is what I mean by saying, let's find the areas within the market that are well suited to the current environment. Let's not get caught up in what did work well in the previous environment. So through 30 years of falling interest rates, people got very comfortable owning things that had low economic sensitivity, but had an ability to pay a dividend whether the economy was good or not. We're in a world today where investors are more interested in finding companies with an ability to benefit from a reflationary environment where they'll be able to pay a higher dividend over time based on a stronger economy and pricing power. Dividend growth, high dividend paying stocks, high dividend growth being the more attractive. Other areas that aren't working currently, telecom, really it fits into that high dividend, low economic sensitivity camp. And then companies that have a lot of their profitability in the future and not a lot of ability to raise price. So for instance, there's lots of software companies that charge a subscription price, which was very attractive for a long time, but may not be able to raise their prices quickly. So this is the Invesco software ETF. If you take out something like Microsoft, this is what the average software stock looks like. It's not been a great space to be in. E-retail, which certainly had a big run up from March of 2020 through February of 2021. Not so much today. Again, in general, some of them very high multiple, high valuation companies. We have digital payments companies, again, had a big run up into April, May, not acting so well today. Healthcare, again, a group that's not so economically sensitive. Certainly areas like biotech and genomics have been weak areas to be. So market's doing a pretty good job sorting. There are some sectors that are well suited to a reflationary environment. And when the market gets jittery, they certainly are going to pull back as well. But these are broken stocks, not just having a correction. So when I go back to what I think is driving things right now, if we take the free cash flow yield of the average company in the S&P, taking out technology, the average company is generating a free cash flow yield of about 5.8% on the capital that they have deployed. If you compare that to a bond at 1.5%, we're getting paid well to take the risk to own those companies. They're generating solid cash flow. And along with that, have an ability to pay pretty good dividends. So when we go back to another time when stocks were really expensive, the free cash flow yield X technology in 2000 was about 2%. But at that point, long-term interest rates were closer to 5%. So you're taking a discounted cash flow yield to own stocks versus fixed income. Today, you're getting close to 3 times as much cash flow as you'd get from a bond portfolio by owning stocks. And we know earnings are growing. Good reason to own them. So valuation-wise, equities continue to make sense if you're in areas that are generating cash. The differential between high PE stocks or high price earnings stocks versus low PE stocks hit an extreme level in the first quarter of 2021. And as you've seen, those high multiple stocks have been correcting, but they're still really expensive relative to value. So growth relative to value, still fairly expensive and certainly well above the norm. So let's talk about exposures. Our largest exposure continues to be financials at just about 30% of the portfolio. Technology, which has been a lower weight than the index, has become a lower weight at the index. Energy's remained about the same. We've taken up our consumer staples based on the recent strength. It looks as though there might be some room to run there. Industrials are about the same. Materials are about the same. We've raised our short-term bond exposure, which in effect is cash. We've been shaken out of a few positions, but not dramatically. Our REIT exposure is a little bit higher. Our consumer discretionary weight is a little higher, although it's still low relative to market. And then we have very low exposure to telecom, utilities, and healthcare. So as we sit today, we have a portfolio that is built for a reflationary environment. And I think that that's what we're going to hear the Fed talk about tomorrow. There is some inflation in the system. The market is confirming it, the way that it's behaving. So as long as the stocks are doing what you would expect them to do, given what you think you know, this is where we want to focus. So looking forward, we know we're in a seasonally strong period of the year. Why is that? Well, there tends to be pretty good flows comes into the stock market at the end of the year and at the beginning of the year. We know that we're going to see a change in Fed policy, and there's a range of outcomes. If, like we expect, we're going to get a slow increase in interest rates over the next year, a slow tightening tends to be quite favorable for stocks. When rates start to rise, but they rise slowly, the market has a tendency over the course of the first year of tightening to be up a little over 15%. If we look at a high inflationary environment with fast tightening, it tends to be less favorable. So obviously we're going to listen to language and we're going to look at the way the market behaves, but it's not impossible that we get rising interest rates and the market acts just fine. In fact, that's what has happened historically. We think the Fed is going to be very careful about raising rates. We know there's a lot of flows to come into the market in January, February, and March. This is the most prolific time of the year for new money to get positioned. And we are not starting from a time when everybody's overinvested. We know that through the course of the fall, the average fund manager took their cash position up to over 5%, which means this cash needs to be redeployed at some point. When we look at cash and money market funds, cash is sitting at $5.5 trillion. So yes, a lot of money got put into stocks this year, but the cash hoard continued to grow. If rates are effectively zero and inflation is 6.8%, it means that on cash, you're losing 6.8% in value. So really cash right now is not a good option, especially if we're in an inflationary environment. We think it needs to be invested in companies that have an ability to raise price and raise their dividends. And we know that share buybacks, again, have hit another new high through the middle of November, over $1 trillion in share buybacks announced, which will continue through into the new year. So there are always things to worry about, and we're always prepared to get more defensive if need be. But as it sits right now, as you can see, our indicators are positive. It's not our opinion, it's what's actually happening in the market. Breadth is strong and it's improving. There are areas of the market that have weak breadth, which we're avoiding. And we will continue to look at the data week by week for signs of change. But seasonally, we're headed into a stronger period, and we would expect probably the year finishes pretty well. If we need to get defensive, we'll get defensive. So with that, I'm going to just check and see if we've got any questions today. I appreciate everybody joining in. Okay, I've got a question from a client here who's asking, are there any long-term demographic trends or factors that could extend or shorten this structural bull market? And that's a great question. In 1981, the baby boomers were really hitting the beginning of their savings and investment phase. In the mid 1980s is when the banks decided that they didn't just need to be in the lending business or the capital raising business, they needed to be in the investing business for their clients. And all 5 of the Canadian banks and all the major US banks went out and bought private client investment companies. If we look at it today, the millennials are just getting engaged in investing their money. And I'm not going to say that the majority of asset management companies and banks really understand millennials yet. There's a different way we have to interface, and there's a different way we have to communicate. This is one of those ways digitally. But arguably, there is a long runway in front of us for the capital accumulation phase for the millennial generation. And frankly, the millennial generation is bigger than the baby boom. So yeah, I think that this could extend the cycle, but we'll have to see. Next question was, where does solar and wind utilities fit in? And how do the manufacturers fit into the current financial environment? So solar has backed off a little bit recently. The long-term picture looks good. They basically consolidated over the course of the year. Wind as well. If we look at Nextera as an example, let's see if I can flip over and find, see if I can jump in here. Oh, I don't have it on my screen. If you were to look at Nextera, NEE on the NYSE, it's been about the best performing utility. And Nextera has the highest percentage of solar and wind. On the manufacturing side, it's a different story. We look at companies like, say, Enphase in solar, and it's got a bright future, but certainly has pulled back recently. But I do think that 2022 should be good. If we think that energy prices from a carbon basis strengthen, oil and gas, then it's very likely that as a comparative cost base, solar looks more attractive. And I think that's it. If there's no more questions, I think we'll wrap it up. I appreciate everybody signing in. I know we're getting into the holiday season. Sadly, we aren't all getting to go to as many parties as we'd like to. But I look forward to seeing people in person. If you've got any questions, don't hesitate to reach out to me. Don't hesitate to reach out to our investment counselors. If you're a client, we'd love to jump on the phone with you or a Zoom call at any point. And if you're not and you'd like to explore it, certainly please reach out. We'd love to talk to new people. Thanks, everybody, and have a great week.